There's a force more powerful than interest rates, more potent than corporate earnings, and more contagious than any virus, a force that dictates the rise and fall of fortunes, the stability of empires, and the panic of entire generations. That force is not a number. It is a story. Look around the modern financial world and ask yourself why seemingly rational people engage in seemingly irrational behavior. Why did a video game retailer stock, whose fundamentals suggest a decline, suddenly rocket to astronomical heights, driven by a collective rallying cry? Why does an asset with no centralized issuer and no intrinsic cash flow, like a digital coin, captivate the global imagination, creating and destroying trillions of dollars in wealth overnight? Why are millions of people, armed with sophisticated technology, choosing option gambling and leverage addiction over the proven, steady returns of passive investment? The traditional models of economics, which rely on the myth of the rational actor, cannot answer these questions. They suggest that people process all available information logically to maximize utility. Yet, the chaos, the frenzy, and the sudden, devastating collapses of our time prove this model is woefully incomplete. It fails because it ignores the human mind's most fundamental engine of decision-making, the emotional, contagious power of a story. This brings us to a text of seismic importance, a book that tears down the ivory towers of traditional finance and provides a critical lens required to understand the new age trading psychology that defines our current era. Narrative Economics by Nobel laureate Robert Shiller. Robert Shiller is not a fringe thinker. He is an academic giant who has spent his career confronting the most comfortable assumptions of modern finance. He is the intellectual architect of behavioral finance, a field dedicated to understanding the profound, predictable influence of human psychology on market outcomes. Long before the meme stocks and the crypto hype cycles of the 2020s, Shiller was already warning the world about the danger of collective emotional manias. He famously predicted the dot-com bubble and co-created the Case-Shiller Index, a foundational tool that demonstrated the irrationality underpinning the 2008 housing collapse. His entire body of work proves one unassailable point. Bubbles are not statistical anomalies. They are sociological phenomena driven by narratives. In Narrative Economics, Shiller formalizes this idea, arguing that contagious popular narratives, stories about technological progress, financial opportunity, social injustice, or fear, are the primary drivers of economic events, often overwhelming the slow, steady pull of fundamental reality. These stories act like viruses, spreading to the population, being slightly modified by each teller and ultimately influencing the mass psychology that determines everything from inflation to investment allocation. The market is not merely a reflection of underlying value. It is a theater of collective storytelling. The book's relevance to the Robin Hood generation and financial influencers is impossible to overstate. Today, narratives are no longer spread slowly through newspapers. They are amplified instantly and globally via algorithms. A single emotionally resonant story, like the narrative of fighting institutional short sellers or the certainty of a new decentralized financial system, can achieve viral velocity, recruiting millions of FOMO-driven participants overnight. This speed and reach have compressed the life cycles of bubbles and panics, making Shiller's lessons a matter of financial survival. He connects the dots between historical manias, like the 19th century railway booms, and the modern mania of Tesla hype and Bitcoin bubbles. The underlying economic details change, but the core human story remains the same, a powerful narrative promising spectacular, immediate riches, often tied to a technological innovation that few truly understand. This is a mechanism that allows the FIRE movement, financial independence, retire early, a goal rooted in long-term discipline, to be hijacked by the short-term, speculative behavior of option gambling. The narrative of instant wealth overriding reality of slow, steady accumulation. This script will explore Shiller's groundbreaking framework, moving chapter by chapter through his meticulous historical examples and sharp psychological analysis. We will break down how to identify these economic narratives, how to measure their spread, and most importantly, how to protect your own capital and decision-making from their contagious influence. We will create a cinematic, deeply educational journey that moves beyond dry equations, looking into the true, human engine of economic reality. Get ready to look at every price movement, every headline, and every stock chart not as a fact, but as a reflection of a powerful, unfolding story. This is a definitive breakdown of how narratives shape our wealth, our markets, and our future. Robert Shiller begins his deep exploration into the heart of market volatility by defining the core concept of his book, Narratives and How They Work. This is not a chapter about traditional economic indicators. It is a venture into epidemiology, sociology, and cognitive psychology, arguing that economic events are fundamentally driven by the spread of infectious ideas. He asserts that a full understanding of economics is impossible without analyzing the dynamics, the longevity, and the contagiousness of popular stories that influence mass behavior. The narrative is a driver of the exogenous shock, the external event, that economists typically treat as an unexplainable variable, but which Shiller proves is predictable once the power of the story is understood. Shiller meticulously defines an economic narrative as a story, simple, easily communicable, and emotionally resonant, that has a potential to influence economic decisions. These stories are not necessarily true, but they must be plausible enough to be widely repeated and convincing enough to motivate action, often driven by the universal human emotions of greed, fear, or moral indignation. He points out that the effectiveness of a narrative lies in its ability to trigger pre-existing mental schemas, those ready-made, simple frameworks in our minds that we use to interpret a complex world. For instance, the narrative of the plucky individual fighting the giant corporation is a schema instantly recognizable from countless movies and fairy tales, making it exceptionally contagious in the financial context of meme stocks. The story is already half written in the listener's mind, requiring only a simple trigger to activate. The central mechanism Shiller identifies is the concept of contagion. Just like a viral pathogen, an economic narrative spreads through social networks, gaining velocity and reach with every person who repeats it. It is not necessarily the most accurate story that wins, but the most easily transmittable one. This is why complex, nuanced arguments about long-term valuation often lose to a simple, declarative story like, "This stock is going to the moon." The phrase is short visually, imaginative, and instantly signals high conviction and high expected return, making it perfectly optimized for rapid transmission across digital platforms. Shiller notes that narratives are subject to mutation. As a story is passed from person to person, it is often simplified, exaggerated, or localized, becoming even more potent and adapted to the specific cultural moment. The original story of a clever technology mutates into a guaranteed source of passive income as it spreads, amplifying the FOMO and potential for irrational exuberance. Shiller also explores the role of prominent public figures in acting as superspreaders of economic narratives. A narrative gains massive credibility and velocity when it is championed by a respected academic, a charismatic entrepreneur, or, in the modern era, a widely followed financial influencer. These figures don't necessarily create the narrative, but they endorse it, lending their personal authority to the story and accelerating its journey from a niche idea to a mass phenomenon. This relationship explains why a single tweet or a highly viewed video can instantly trigger a massive wave of retail buying, transforming an otherwise quiet stock or asset into a global talking point. The story of the market genius is married to the story of the great opportunity, creating an irresistible force. The modern market, characterized by social media financial panic cycles and the Robin Hood generation, is the perfect petri dish for Shiller's theory of narrative contagion. The speed and anonymity of platforms like Reddit, Twitter, and TikTok have supercharged a virus-like spread of economic stories, compressing what used to take years into a matter of days. Consider the Bitcoin bubble narrative, the core story that of a decentralized, scarcity-driven asset that acts as a hedge against corrupt central banking is potent and deeply appealing. However, the narrative mutates quickly. It moves from technological innovation to a quick way to get rich, then to the only way to survive inflation, becoming simplified and emotionally extreme with each jump. The retail investor is rarely buying the technology. They are buying the story that is most active and viral at that moment. The zero-commission trading environment facilitates this, eliminating the friction of transaction costs and making it easier for impulsive, narrative-driven behavior to translate immediately into market action. Shiller's lesson here is vital. The astute investor must become a narrative epidemiologist. They must learn to identify the prevailing stories, track their emotional temperature, and assess their rate of spread, understanding that when a story reaches peak saturation, when it is being repeated by taxi drivers and local shop owners, it is likely reaching a point of maximum financial danger. This is the point when narrative has done its job of recruiting the last available buyer, leaving the market ripe for a sudden, painful correction when reality finally interrupts the story. The first step in winning the economic game is realizing that you are primarily playing a game of stories. To establish the necessity of narrative economics, Shiller dedicates the second chapter to a clear, critical comparison of rational and behavioral economics. He argues that the failures of traditional, rational models that presuppose all agents are logical, self-interested, and possessing perfect information, made the emergence of narrative-focused approach inevitable. The history of economic thought, Shiller suggests, is a slow, often reluctant, crawl toward accepting the messy, unpredictable reality of human psychology. The rational actor model is the primary target of Shiller's critique. In this ideal academic world, economic agents use Bayesian reasoning, instantly adjust their expectations based on new information, and make optimal decisions to maximize their lifetime utility. If this model were accurate, financial markets would exhibit minimal volatility, bubbles would be rare, and massive panics would be impossible, as prices would always instantly reflect fundamental value. Shiller points to the massive, sustained bubbles in housing and tech and the recurrent crashes as irrefutable empirical evidence that the rational actor is a myth. People are not logic machines. They are emotional, heuristic-driven beings who are prone to making systematic, predictable errors. Behavioral economics, the field Shiller helped to pioneer, corrected some of these flaws by introducing concepts like loss aversion, overconfidence, and herd mentality. This framework acknowledged that cognitive biases cause individual deviations from rationality. However, Shiller argues that even behavioral economics is incomplete because it often focuses only on individual biases. While helpful, it still doesn't explain the massive, simultaneous, and correlated irrationality that drives a financial bubble. Individual cognitive errors by themselves do not create a global mania unless there is a mechanism to synchronize those errors across millions of people. This is where narrative economics steps in as the crucial bridge. Shiller asserts that narratives are the mechanism of correlated error. The narrative, the contagious story, is a tool that synchronizes the individual biases of millions of people, making them all prone to the same overconfidence or the same panic at the same time. The individual bias of confirmation bias, only seeking information that supports a pre-existing belief, is localized, but the narrative of the new technological revolution is what directs millions of people to confirm the same flawed belief, e.g., that the internet company with no revenue is worth billions. The narrative acts as a kind of collective cognitive filter, focusing and directing the emotional energy of the crowd. Shiller uses historical examples, such as the 18th century South Sea bubble, to illustrate this. The core rational elements, a company chartered to trade, were utterly overwhelmed by the narrative of colonial wealth and impossible riches. The bubble was driven by the story, not the prospectus. The rational actor model would have predicted immediate collapse. The reality was years of sustained, narrative-fueled madness. The transition from rational to narrative economics is the shift from studying what people should do to rigorously studying what people actually do and, critically, why they all do it at once. The tension between rational and behavioral models is the daily struggle for the FIRE movement and the Robin Hood generation. The rational goal, achieving financial independence through disciplined savings and investment, is often derailed by the behavioral temptations amplified by modern narratives. Zero-commission trading and instant access to markets have removed the friction that once imposed a form of rational discipline. Consider the passive versus active investing debate through Shiller's lens. The rational choice is to be passive, accepting market returns with minimal costs. But the narrative of genius day trader, or I can beat the system, is so compelling that it drives millions into hyperspeculative behavior. This is the narrative triumphing over the math. The professional investor, armed with Shiller's perspective, understands that their biggest advantage is resisting the market's narratives, which they know are designed to exploit behavioral flaws. They realize that when a narrative is peaking, like the story of an asset class only going up, it is a signal to reduce exposure, not to increase it. The rational move, ironically, is to act contrary to prevailing narrative-driven emotion, making the narrative itself a tool for measuring market risk. To validate his theory, Shiller dedicates his third chapter to illuminating some examples of infectious narratives that have demonstrably driven major economic outcomes throughout history, proving that the phenomenon is recurrent, systematic, and deeply human. He meticulously draws parallels across centuries, showing that while the specific details of the technology change, the core human narrative themes remain constant and highly contagious. Shiller begins with a narrative of the new era of technology and productivity. This is one of the most powerful and perennial stories in economics, responsible for everything from the 19th century railroad bubble to the late 1990s dot-com mania. The core theme is that a new technology, whether steam engines, telegraphs, or the internet, will fundamentally change the way business is done, rendering old valuation metrics obsolete and promising impossible, limitless growth. This story is so contagious because it appeals to our innate optimism and our faith in human ingenuity. In the dot-com era, the narrative was that eyeballs and clicks were more important than profits, and traditional valuation methods were dismissed as old economy thinking. The narrative provided a rationalization for irrational exuberance, allowing investors to ignore fundamental analysis because the story of the new era was simply too compelling to resist. He moves on to the story of the American dream and homeownership. This narrative, especially prominent in the lead-up to the 2008 financial crisis, was not purely technological, but socio-political. The story was that owning a home was the safest investment, that house prices never fall, and that expanding homeownership was a moral and civic good. This narrative was reinforced by government policy, media, and the financial industry, becoming a socially acceptable financial guarantee. This powerful story, repeated constantly, allowed consumers and lenders alike to ignore the accumulating risk of subprime lending. The underlying instruments were complex, but the motivating factor was a simple, universally accepted narrative. When the narrative finally broke, when people realized that houses, in fact, could fall in value across an entire nation, the behavioral collapse was catastrophic, freezing credit and triggering a global panic. Another potent example is the narrative of the thrift ethic and financial prudence. This story, dominant after the Great Depression, emphasized saving, avoiding debt, and relying on predictable, low-risk investments. While fundamentally sound, even this positive narrative can become economically problematic if it causes excessive caution, leading to a liquidity trap where consumers hoard cash and inhibit economic stimulus. Shiller's point is that no narrative is purely good or bad. The economic impact depends on its magnitude and its ability to trigger massive, correlated behavior. Even if behavior is overly cautious, the key is the contagion, the scale of the synchronization. The contemporary market offers two textbook Shiller narratives: the Tesla hype and the decentralized fantasy of Bitcoin bubbles. The Tesla story is the ultimate synthesis of the technological new era narrative combined with a visionary genius narrative. It is not fundamentally about quarterly car sales. It is about the story of sustainable energy revolution, technological disruption, and a charismatic, visionary leader. This powerful narrative allows the stock to trade at valuations that are mathematically inexplicable by traditional metrics. The faith in the story is what holds the price floor, making it a perfect example of narrative-driven asset pricing. The Bitcoin story is the modern equivalent of a 19th century gold rush narrative combined with radical political manifesto. The story is about scarcity, trustlessness, and liberation from central banks. This appeals to a deep-seated suspicion of authority. The narrative's viral quality is its simplicity and its emotional resonance, far outweighing the complex, technical reality of blockchain or the environmental costs. The social media financial panic cycles merely accelerate the spread and the intensity of the get-rich or get-left-behind sub-narrative, making the asset's price trajectory a pure reflection of the story's current viral load. The lesson for the modern investor is to identify the dominant narrative and understand that when that story begins to fade or is replaced by a counter-narrative, the price will collapse even if the underlying technology remains the same. Having established that narratives matter, Shiller tackles the difficult question of modeling contagious narratives. He moves beyond qualitative observation into the territory of quantitative analysis, arguing that if narratives act like infectious diseases, they can be studied using the same mathematical tools of epidemiology, providing a framework for forecasting their potential economic impact. This chapter is the formal bridge between the humanities of storytelling and the mathematics of macroeconomics. Shiller suggests adapting the classic SIR, susceptible, infected, recovered, model used to track diseases like the flu, applying to economic ideas. In this context, individuals are categorized as susceptible to a narrative currently infected by it, meaning they are actively repeating it and acting on it, or recovered, meaning they have been burned by the narrative or have dismissed it, making them immune, at least temporarily. The infection rate, the speed at which the story spreads, is influenced by media saturation, social connectivity, and the story's inherent emotional resonance. The recovery rate is influenced by negative economic outcomes, such as a sharp market crash or a bankruptcy that disproves the narrative. By measuring these rates, Shiller argues, economists can build models that predict the timing and magnitude of narrative-driven market movements. Crucially, Shiller focuses on the feedback loops between the narrative and the economy. The narrative doesn't just spread independently. It is reinforced by the economic events it creates. For example, the narrative of a rising stock price is validation of the business model spreads. As more people believe it and buy, the price does rise, which then serves as empirical evidence supporting the narrative. This positive feedback loop, the self-fulfilling prophecy, is what causes the exponential growth of a bubble. Conversely, a sudden price drop creates a negative feedback loop. The narrative of inevitable growth is replaced by the narrative of systemic panic, which causes more selling, further validating the panic narrative. Modeling requires tracking the point where the positive feedback loop flips into a negative one. Shiller uses the internet and search trends as a modern tool for narrative measurement. By tracking the frequency of key phrases related to specific narratives, such as get rich quick, financial doom, or disruptive technology, economists can gauge the narrative's current viral load and estimate its infection rate in real time. This is a radical departure from traditional economics, which relies on backward-looking data like GDP and unemployment. Narrative economics proposes using real-time social data to anticipate shifts in mass psychological momentum. The key insight is that the quantity and emotional intensity of the search behavior is itself an economic indicator. For the investor navigating the age of AI-driven hedge funds and quant strategies, Shiller's modeling is a powerful tool. While quants focus on pricing anomalies, the narrative investor looks for psychological anomalies that the algorithms miss. A quant model might see unusual buying volume in a meme stock, but Shiller's approach explains why the volume is there. Because the narrative of sticking into hedge funds has reached peak contagiousness. This framework is critical for understanding the behavior behind ETF dominance. When a narrative of passive safety reaches a critical mass, it funnels massive amounts of capital into index tracking ETFs. While this is a rational, low-cost choice, Shiller would look at the narrative concentration risk. If the widely accepted story suddenly flips, say, the narrative of guaranteed growth is replaced by passive indices are overvalued and unstable, the synchronized selling pressure from millions of synchronized investors could trigger a massive, narrative-driven liquidity event. The model's lesson is that mass psychological synchronization, facilitated by a narrative, is a true hidden variable of systemic risk. The professional understands that the market is a collective mind, and modeling its mood is as important as modeling its cash flows. In this chapter, Shiller explores the vital role of confidence in its fluctuations as both an economic narrative itself and a core moderator of other narratives. Confidence is not merely a reflection of underlying fundamentals. It is a contagious story people tell themselves about the future and about the stability of the system. The sudden collapse of confidence, regardless of fundamental reality, is one of the most destructive forces in economic history. Shiller identifies confidence as a self-reinforcing narrative that relies on the belief that other people also believe. For an entrepreneur to invest, they must be confident in future demand. But that confidence requires them to believe that other entrepreneurs are also confident and investing, which ensures the general economic climate is buoyant. This creates a powerful coordination game driven entirely by shared expectations. The narrative of the economic boom is just beginning, encourages investment, hiring, and risk-taking, which then for a time creates the boom itself. The narrative becomes a temporary economic law. He distinguishes between two types of confidence narratives. The first is financial confidence, the belief in the stability of institutions, the integrity of markets, and the trustworthiness of financial contracts. When this narrative breaks, as in a banking panic, the entire system freezes, even if the majority of banks are solvent, because the story of systemic failure has become infectious. The second is business confidence, the belief in the future growth of specific sectors, innovation, and corporate profitability. This is a narrative that drives stock market valuations far beyond historical averages, often creating an asset bubble fueled by the intoxicating certainty of future success. Crucially, Shiller details how the narrative of confidence is tied to the concept of legitimacy. For a market or an institution to function, the public must accept the story of its legitimacy. The narrative of the stock market is a fair place for retail investors is essential. When this narrative is challenged by a highly visible event, like a massive corporate scandal or the perception of meme stock manipulation, confidence can evaporate instantly, leading to a flight of capital. Shiller uses historical examples of bank runs to show that the physical loss of confidence, people literally lining up to withdraw money, is merely the outward manifestation of the narrative of mistrust going viral. The loss of confidence is the loss of a shared, positive story. The volatility of the modern market, particularly in high-growth, high-speculation sectors, is a direct result of the extreme fluctuations in confidence narratives. The Tesla hype is not just a growth story. It is a story of unbreakable confidence in a singular vision, which shields the stock from rational critique. When bad news hits, the narrative of the faithful will be rewarded kicks in, preventing a catastrophic price drop because the core belief system remains intact. However, in the crypto casino environment, confidence is often cyclical and transient. The confidence narrative is that the asset is the future of money, but this is repeatedly interrupted by the counter-narrative of regulatory crackdown or exchange failure. The massive, swift crashes in crypto are a perfect example of a confidence narrative instantaneously flipping into a panic narrative, often accelerated by social media synchronization. The Robinhood generation often fails to grasp that their financial fortunes are not tied to the code of the asset, but to the collective belief in the story of the asset, which is far more fragile and volatile. Shiller's lesson is that the smart investor must view confidence not as a psychological constant, but as a highly leveraged asset. When it is abundant and cheap, the price of everything is high. When it becomes scarce, the price of everything collapses. In Economic Change and Technological Narratives, Shiller explores the most recurrent and powerful narrative theme in modern history, the story of disruptive innovation. Economic progress is driven by genuine technological change, but the impact of that change on markets and society is driven by the contagious stories that attach themselves to the new technology, often leading to massive, short-lived bubbles that reward storytellers more than innovators. Shiller argues that technological change, whether the invention of the automobile, the radio, or the internet, creates a narrative vacuum. The public understands that something big has happened, but they lack the complex technical and economic models to properly assess its true long-term value. This vacuum is instantly filled by a simple, compelling story that uses the technology as a hook for ancient, emotionally powerful themes. Rapid wealth creation, the obsolescence of the old guard, and the dawn of a new, perfect economic system. The narrative is always grander than the reality. The story gives the public permission to believe that this time is different. The four most dangerous words in finance. He uses a historical narrative of the internet revolution as a perfect modern case study. The underlying technology was profoundly innovative, but the narrative that spread was that all companies touching the internet were instantly worth billions, regardless of their business plan or profit potential. The story was that the traditional P/E ratio was obsolete, replaced by metrics like price to clicks or price to eyeballs. This powerful narrative created a sustained feedback loop. The belief in the story drove capital into dot-com stocks, which drove prices up, which reinforced a narrative, proving to skeptical observers that the new era really was here. The story essentially hijacked the rational decision centers of millions of people simultaneously. Shiller also explores the flip side, narratives that block technological change. Not all narratives are positive. Sometimes, a story of fear, skepticism, or moral condemnation, such as a narrative that a certain technology is inherently dangerous, job-destroying, or morally corrupt, can slow down or even block genuinely beneficial economic change. This demonstrates that narratives are a two-way street, influencing both excessive exuberance and excessive caution. The economic outcome is dictated by which narrative achieves viral dominance. The ultimate driver is not the patent filing, but the public's acceptance of the story about the patent filing. The contemporary market is defined by technological narratives, particularly the Bitcoin bubble and the sustained high valuation of companies like Tesla. The Bitcoin narrative is a perfect modern technological story. It is complex, decentralized, and promises massive, fundamental change, the replacement of fiat money. Because few people fully understand the technical mechanism of the blockchain, the narrative fills a comprehension gap, allowing people to focus on the simple, emotionally satisfying story of scarcity and revolution. The story dictates the value, not the utility. For the investor dealing with fractional shares culture and the constant temptation of option gambling on tech stocks, Shiller's lesson is a defense mechanism. He teaches that when a company's valuation relies almost entirely on a future narrative that is universally accepted and widely repeated by financial influencers, the risk of a sudden, painful narrative correction is exceptionally high. The professional must detach themselves from the technology's potential and focus on the price of the story. When the price reflects a narrative that is already 100% saturated in the public imagination, the EV is overwhelmingly negative. The intelligent investor's role is to buy the asset before the story goes viral and sell it once the story has achieved peak contagion. In this chapter, Shiller turns his attention to narratives about economic shocks, focusing on how contagious stories emerge in response to sudden, significant, and destabilizing events like wars, pandemics, or natural disasters. These shocks are not merely economic facts. They are immediately processed and interpreted through a narrative lens, and it is the spread of this explanatory story that dictates the depth and duration of the resulting economic downturn or recovery. Shiller emphasizes that a shock creates an explanatory urgency. When a massive sudden event occurs, such as a war or a health crisis, people crave a simple, satisfying story to explain why it happened and what it means for the future. This need for narrative closure is what drives media attention and social discussion, making these stories incredibly contagious. For example, a sudden stock market crash is not just a collection of trades. It immediately becomes a story of the banker's greed, the system is rigged, or the inevitable correction. It is a dominant narrative that emerges from the chaos that determines whether the public responds with collective confidence, leading to recovery, or with collective panic, deepening the crisis. He explores the narrative of the Great Depression and fear of deflation. This was not merely an economic slump. It was a sustained, decade-long narrative of systemic failure and perpetual scarcity. The story that spread was that it was prudent to hoard cash, avoid debt, and defer all major purchases, as prices would only continue to fall. This self-fulfilling narrative of deflationary doom inhibited investment and consumption, prolonging the crisis for years. This demonstrates the immense power of a sustained, negative narrative to override fundamental economic stimuli, proving that economics is fundamentally a branch of mass psychology. Shiller also examines the narrative of the inflation scare. This story, which constantly resurfaces in modern economies, is often rooted in the simple, familiar story of governments printing too much money. When this narrative achieves viral status, it triggers a change in mass behavior. People start demanding higher wages, raising prices, and pulling money out of low-interest-bearing accounts. This collective, narrative-driven behavior can itself trigger the inflation that people fear, creating another powerful self-fulfilling prophecy. The actual volume of money printing is less important than the public's narrative acceptance of the idea that printing money inevitably equals financial catastrophe. The modern era, marked by global inflation waves and geopolitical instability, provides fresh context for Shiller's shock narratives. The global inflation wave of the 2020s was fueled not just by supply chain issues, but by the pervasive and viral narrative that the government printed too much money during the pandemic. This simple, easily repeated story synchronized consumer expectations, giving businesses a social license to raise prices and consumers the expectation that they needed to buy now before prices went up further. For the investor navigating passive versus active investing, the shock narrative is a constant threat. A sudden economic shock can trigger a narrative of the market is too risky, causing passive investors, the bedrock of stability, to violate their long-term conviction and sell their ETF dominance holdings at the precise moment of maximum loss. The professional investor guided by Shiller, must view a shock not as an economic event, but as a narrative opportunity. They know that the most extreme narrative, the end of days panic story, is typically the most financially profitable time to invest, as it pushes asset prices to irrational lows. The lesson is to be a narrative contrarian, buying assets when the story of catastrophe is at its loudest. The stability of the global economy rests on the pervasive and fragile narratives we tell about financial institutions and regulations. Shiller dedicates this chapter to demonstrating how the stories we accept about the integrity of banks, the competence of central bankers, and the fairness of market regulations are the unseen bedrock of economic trust. When these narratives break, the result is often systemic panic far worse than any fundamental economic contraction. Shiller emphasizes that trust is entirely narrative-based. A bank's solvency relies not just on its balance sheet, but on the public's narrative acceptance that the bank is safe and well-managed. The classic bank run, a catastrophic event where depositors rush to withdraw their money, is not caused by a rational assessment of every bank's health. It is caused by the viral spread of the narrative of mistrust. Once the story of this bank is failing takes hold, it rapidly contaminates the entire sector, becoming a self-fulfilling economic disaster. The story creates the reality. He also explores the narratives surrounding central banks. For a central bank, like the Federal Reserve, to be effective, it must maintain the narrative of its competence, independence, and absolute control over inflation and stability. When this narrative is challenged, either by a sustained economic miss or political interference, its tools become less effective because the public's behavioral response changes. If the public starts to believe the narrative that the Fed has lost control, their expectations of inflation and stability shift, often rendering the central bank's policies inert. The power of the Fed lies less in its balance sheet and more in the credibility of its narrative. Crucially for the modern era, Shiller analyzes a narrative of market fairness and integrity. The stock market and other financial platforms rely on the public accepting the story that the game is fair, regulated, and not unduly manipulated. The narrative of meme stock manipulation, the belief that the system is rigged to favor institutional players, is extremely destabilizing. It drives retail investors away from regulated markets or, conversely, into hyper-speculative, coordinated short squeezes driven by moral outrage. When the narrative of fairness breaks, it fosters a climate of resentment and distrust, driving capital toward perceived unregulated sanctuaries like certain forms of crypto, which carry their own set of narrative risks. The modern investor, operating in an environment of fractional shares culture and cheap leverage through technology, is acutely exposed to the vulnerability of the institutional narrative. The narrative of the market as a casino is exceptionally strong among the Robin Hood generation, fueled by the visible disparity of outcomes and the perceived impunity of large institutions. This narrative encourages hyperspeculative behavior because if the game is seen as unfair, the only rational response is to gamble big, hoping to get lucky before the rigged game catches up to you. Shiller's lesson for the individual is to recognize that stability is a narrative asset. The safety and liquidity of index funds dominating global wealth is contingent on the narrative of trust in the system. The smart investor must learn to monitor the health of this narrative. They must look not at the official statements, but at the public's emotional response to those statements. When the collective story of institutional competence is strong, risk premiums are low, and stability prevails. When the story falters, the resulting panic is a result of millions of people all suddenly realizing that the narrative of stability was just a story. The most profitable contrarian bet is often buying the institutional narrative, i.e., buying the market, when the panic narrative has driven the price of trust to an irrational low. Few economic events demonstrate the power of narratives as vividly as the 2008 financial crisis, and Shiller dedicates a detailed chapter to dissecting the housing bubble and its narratives. He shows that the decade-long catastrophic buildup of risk was not driven by complex derivatives, but by the simple, universally accepted stories that provided the psychological foundation for the entire edifice of debt and speculation. The primary, most infectious narrative was house prices never fall. This story, pervasive across media, government, and common conversation, became the core psychological safety net for millions of borrowers and lenders. It was a simple, absolute claim that justified excessive borrowing and reckless lending. If prices never fall, then a mortgage, even a subprime one, is effectively guaranteed because the collateral will always be worth more than the loan. This narrative gave ordinary people the emotional license to violate their own financial prudence, believing they were making a safe, patriotic investment. It was an ultimate triumph of a simple, comforting story over complex, statistical reality. The secondary narrative was the American Dream narrative, which intertwined homeownership with moral virtue and national success. The story was that every citizen deserved a home, and therefore, financial innovation that expanded access to homeownership was inherently good. This narrative acted as a powerful political and social pressure, disarming critics and justifying massive regulatory complacency. It turned sound underwriting principles into barriers to social equity, creating an environment where lenders felt socially obligated to push loans onto unqualified buyers. The moral narrative provided the perfect cover for profound financial recklessness. Shiller also explores the crucial role of expert narratives. The story was not just spread by the public. It was endorsed by economists, financial media, and Wall Street executives who created sophisticated, dense narratives about risk dispersal and financial innovation that obscured the simple underlying truth. These expert narratives provided the intellectual justification for the dangerous behavior, allowing professionals to believe that their new financial instruments had magically eliminated systemic risk. The complexity of the financial products served as a narrative shield, protecting the simple, flawed story of ever-rising prices from critical scrutiny. The housing bubble provides a powerful lesson for the modern investor facing the highly emotional FIRE movement goals. While homeownership is desirable, Shiller's analysis warns against treating it as an untouchable, guaranteed asset class. The FIRE movement's asset allocation must account for the narrative risk of property bubbles. An investor putting 80% of their net worth into a primary residence and treating it as a safe investment is repeating the core psychological mistake of 2005, believing the local housing narrative is immune to global forces. The key lesson is to identify the narrative of guaranteed return in any asset class. When any asset, be it property, Bitcoin, or a specific technology stock, is commonly discussed with the absolute certainty that it can only go up, it is approaching peak narrative risk. The professional, contrarian investor recognizes that these narratives are most powerful just before they collapse. Shiller's work encourages the use of skepticism and objective valuation tools, like the price-to-rent ratio, to cut to the powerful, emotionally comforting story of guaranteed property wealth and ensure that their overall asset allocation is diversified against the possibility that the narrative might fail, which history proves it always does. In this powerful and sociologically relevant chapter, Shiller explores narratives about distribution and inequality, arguing that the stories we tell about who deserves wealth, why people are rich or poor, and the fairness of the economic system are themselves highly infectious and capable of driving massive economic and political changes, from populist uprisings to sustained periods of policy stability. These narratives define our collective tolerance for wealth gaps and shape our willingness to support redistributionary policies. Shiller notes that inequality is not purely a quantitative metric. It is an emotional and narrative construct. People's tolerance for inequality is heavily influenced by the narrative of opportunity. If the prevailing story is that society is a true meritocracy where everyone has a fair chance to succeed and that wealth reflects skill and hard work, the self-made millionaire narrative, people tend to accept a high degree of wealth concentration. This narrative acts as a social lubricant, allowing the system to function without mass resentment. However, if the narrative shift to one of the system is rigged, or the rich get richer by exploiting the poor, tolerance for inequality evaporates. This narrative often gains traction during periods of high, visible inequality and acts as a powerful motivator for political change, driving everything from populist voting patterns to movements demanding wealth taxes or financial regulation. The rise of the meme stock phenomenon is a perfect contemporary example of this narrative in action. The retail traders' coordination was explicitly fueled by the contagious story of fighting a perceived rigged system, institutional short sellers. The trade was as much about moral narrative as it was about financial gain. Shiller also examines the narrative of technological unemployment. The story that robots and AI are taking all the jobs is highly contagious and immediately creates anxiety about future inequality. While the economic reality is complex, The power of this narrative compels governments, companies, and individuals to prepare for future scarcity, influencing education policies, investment decisions, the fear of being an obsolete sector, and consumer sentiment. This shows that the narrative of economic scarcity or abundance is a massive, independent variable influencing macro-level behavior. The contemporary investor, operating in an environment of global inflation waves and high inequality, must be attuned to the narratives about distribution. The strength of the FIRE movement is partly a reaction to this. It is a personal narrative of opting out of a perceived rigged system to achieve self-sufficiency. However, the use of hyperspeculative behavior and option gambling by the Robin Hood generation is a clear, narrative-driven response to the feeling that traditional, slow methods of accumulation are insufficient to overcome the structural economic disadvantage. Shiller's lesson here is crucial for political and financial stability. Narrative risk is structural risk. If the narrative of the market is fair continues to erode, capital will become increasingly concentrated in highly volatile, high-risk assets like crypto or in passive index funds as people give up on active, individual stock picking. The intelligent investor must recognize the potential for sudden, narrative-driven policy changes, such as wealth taxes or massive regulatory shifts, which can wipe out portions of their capital. Protecting one's wealth involves not just analyzing cash flows, but tracking the emotional intensity and contagion of the inequality narrative to anticipate the next major political or social inflection point. The stories we tell about fairness today dictate the tax code of tomorrow. In Narratives in the Labor Market, Shiller expands his focus beyond capital markets to demonstrate how infectious stories shape fundamental issues of employment, wages, and professional identity. He argues that narratives drive job choices, influence wage rigidity, and determine the social status, and thus the pay of various professions, often overriding the simple supply and demand equations of classical economics. Shiller begins with the narrative of the dignity of work. This story, which emphasizes the moral value of labor regardless of its pay, is a powerful force that encourages people to take jobs and perform duties that may not be financially optimal. When this narrative is strong, it can suppress wage demands and increase worker loyalty. Conversely, a counter-narrative of the exploited worker can trigger massive, coordinated unionization efforts and political movements demanding living wages. The difference in economic outcome is dictated by which narrative achieves viral dominance within the workforce. He also analyzes the enduring narrative of the entrepreneurial hero. This story, dominant in American culture, celebrates the risk-taker who drops out of school and builds a billion-dollar company. This narrative is highly contagious and motivates millions of people to engage in new business formation, risk-taking, and innovation. While positive for dynamism, Shiller notes that this narrative can create financial bubbles, e.g. the dot-com era, where the story of the young founder justified excessive valuations, and can skew policy toward favoring founders over employees. The narrative effectively creates a self-fulfilling prophecy of innovation, but often with massive, hidden social costs. A critical point is the influence of narratives on wage rigidity. Economists struggle to explain why wages tend to be sticky, resisting quick downward adjustments even during recessions. Shiller argues this is due to the powerful narrative of fairness and expected progression. People expect their wages to remain stable or rise over time, and a sudden, sharp wage cut is interpreted as a violation of a social contract, a breach of the fairness narrative, which can trigger resentment, low productivity, and labor disputes. The wage floor, therefore, is not purely an economic variable. It is protected by a deeply ingrained narrative of social entitlement. The resistance to wage cuts is an emotional and narrative phenomenon, not a purely rational one. The impact of narratives on the labor market is highly visible in the era of financial TikTok and YouTube gurus and the changing nature of work. The gurus don't just sell investment advice. They sell a narrative of escape, the story that you can transcend the drudgery of the traditional labor market through trading or passive income. This narrative, amplified by success stories and lifestyle images, influences career choices and encourages a psychological shift toward day trading psychology in the 2020s. Shiller's lesson for the investor is that labor is a narrative asset. The skills and professions that are deemed socially valuable, those with strong, positive narratives attached to them, e.g., the data scientist is the new genius, will attract capital and command higher wages, regardless of transient supply and demand fluctuations. Conversely, professions with fading narratives will see their wages stagnate. When analyzing a company, the smart investor must look not just at its labor costs, but at the narrative health of its workforce. A company with a strong internal narrative of fairness and opportunity will likely have lower turnover and higher productivity, which is an intangible yet massive economic asset that often outweighs short-term efficiency gains. In the concluding chapter of his analysis, Looking Forward, Robert Shiller synthesizes his findings to offer a framework for applying narrative economics to future economic forecasting and policy. He acknowledges the complexity of his model, but insists that future economic analysis must formally incorporate the study of viral stories, moving beyond the simple quantitative models that have consistently failed to predict major manias and crises. Shiller emphasizes the need for narrative surveillance. Just as public health officials track the mutation and spread of pathogens, economists and financial professionals must systematically track the mutation and spread of economic narratives. This requires using modern tools like social media data, content analysis, and sentiment tracking to gauge the current narrative environment. The goal is not to predict which stock will rise, but to identify when a dangerous, self-reinforcing narrative, like guaranteed asset appreciation, has reached a critical, contagious mass, signaling a major market inflection point. The surveillance is the preparation for the inevitable moment when the story collapses. He advocates for narrative intervention in policy. If economic events are driven by narratives, then policy must also address the narratives themselves, not just the underlying fundamentals. For instance, fighting inflation requires not just adjusting interest rates, but actively countering the viral inflation scare narrative through clear, credible communication designed to stabilize public expectations. Similarly, preventing bubbles requires actively challenging the dominant narratives of new era or guaranteed wealth before they reach fever pitch, rather than waiting for the bubble to become so large that its inevitable collapse is systemic. This is a call for policymakers to become narrative architects alongside being fiscal managers. A key challenge for the future is the amplification of narratives by digital technology. Shiller recognizes that the speed of social media, the algorithmic filtering of information, and the rise of hyperpersonalization mean that narratives now achieve viral velocity and extreme emotional saturation faster than ever before. This creates shorter, more frequent, and more severe boom-bust cycles. Future forecasting must account for this algorithmic acceleration of human behavior, recognizing that the emotional contagion is now global and instantaneous. This environment makes the need for disciplined, narrative-aware investors more urgent than ever before. For the investor, the final lesson of Looking Forward is to embrace the role of the narrative contrarian. In an age where digital markets amplify greed and fear, the safest position is to deliberately act against the prevailing, most contagious story. When the narrative is about cheap leverage through technology and guaranteed crypto returns, the contrarian is reducing leverage and taking profits. When the narrative is about financial panic cycles and the impending collapse of the market, the contrarian is deploying capital. Shiller's work provides the ultimate defense against the market's psychological manipulation, the understanding that the market price is largely a reflection of the current collective story, not the long-term value. The investor's edge comes from recognizing that the most profitable moment to buy is when a catastrophic counter-narrative has driven the price to an irrational low, and the most profitable moment to sell is when a euphoric narrative is so pervasive that everyone believes the price can only go up. The future of smart investing is rooted in narrative literacy, the ability to read the collective mind of the market and detach your own decisions from its volatile, ever-changing stories. If Robert Shiller were to observe the financial world of the 2020s, he would not be surprised. He would see a magnificent, terrifying confirmation of narrative economics on a scale never before witnessed. His core thesis, that contagious stories drive economic action, has been amplified by algorithmic filtering, instant connectivity, and unprecedented liquidity. He would analyze the landscape not with judgment, but as a risk epidemiologist tracking a superstrain of narrative contagion. Shiller would be keenly interested in the AI-driven hedge funds and algorithmic trading, but would frame their dominance through a narrative lens. He would argue that these systems are themselves a product of the most powerful narrative in modern finance, the narrative of superior rationality. This story suggests that AI and quant strategies are immune to human emotion, and therefore, they are the only truly rational actors in the market, inevitably destined to outperform flawed humans. However, Shiller would quickly point out the hidden narrative risk in this setup. Firstly, the narrative of AI infallibility creates a complacency bubble among human decision-makers, leading them to blindly trust systems they don't fully understand, a form of collective abdication of responsibility. Secondly, while the AI itself is rational, the data it is trained on is a historical record of human narrative behavior. If the AI learns to exploit short-term behavioral anomalies driven by narratives, it will inherently accelerate the speed and severity of those anomalies. Crucially, Shiller would warn of the correlated failure inherent in this narrative. When most quant and algorithmic systems are running similar models trained on similar datasets, the underlying narrative is that this type of behavior is statistically optimal. When an external unmodeled shock occurs, a genuine black swan outside the training data, the synchronized, simultaneous response of these rational systems will create an exponentially fast liquidity collapse, driven by a narrative of automated panic. The story of AI supremacy, therefore, creates a massive, systemic, uncalculated risk for the entire market. This environment is the ultimate laboratory for Shiller's theories on contagion. He would view financial TikTok and YouTube gurus as the ultimate superspreaders of infectious financial ideas. They are not selling alpha. They are selling a narrative of certainty and lifestyle. The story is simplified. This is the next 10x coin, emotionally charged, targeting FOMO and envy, and perfectly optimized for viral transmission via short-form video and algorithmic amplification. The meme stock manipulation is a pure narrative-driven phenomenon. Shiller would analyze the retail coordination not as a financial event, but as a sociological one driven by the powerful, contagious narrative of moral retribution against Wall Street. The trade was a performance of the story. The narrative provided the moral and psychological justification for holding the asset far beyond any rational valuation. This is the ultimate example of the story overriding the spreadsheet. The market's volatility became a reflection of the narrative's emotional intensity. The price only began to stabilize when the counter-narrative, the story of institutional patience and inevitable capital advantage, began to gain traction. Shiller teaches that the professional can use the narrative's emotional saturation as a near-perfect counterindicator for when to short or reduce exposure. The crypto casinos and NFT madness are the quintessential narrative economic bubbles. Shiller would identify three dominant, highly contagious narratives driving this space. The scarcity narrative, the story that a finite digital asset like Bitcoin is the ultimate hedge against perpetual currency debasement. This simple, powerful story creates a massive psychological demand floor. The revolution narrative, the story of decentralization, liberation from banks, and financial anarchy. This appeals to anti-establishment sentiment and globalizes the appeal. The hyperwealth narrative, the story of guaranteed 100x returns and instant generational wealth. This is the pure FOMO and leverage addiction narrative. Shiller would observe that the extreme volatility is a direct function of the fragility and competition of these narratives. The price collapses when the scarcity narrative is temporarily overpowered by the fear narrative. Regulation is coming. Or the fraud narrative, this exchange failed. The entire NFT space, hyperspeculation on digital collectibles, is a pure expression of the status and signaling narrative, where the story is about proving membership in an exclusive digital club, temporarily creating high value where there is no intrinsic utility. The ultimate risk here, Shiller would warn, is that the price collapse will be total when the social narrative fades, leaving the asset with no community and no story to sustain its value. Shiller's framework allows for a far more nuanced comparison of traditional financial ideas in the modern context. Dollar cost averaging. DCA Shiller would endorse DCA as the ultimate narrative intervention strategy for the individual. DCA is not just a mathematical technique. It is a psychological narrative, the story of slow, steady, and safe that an investor tells themselves. It is a decision structure designed to eliminate the powerful, narrative-driven impulses to time the market or buy the dip based on the prevailing hype. It is a commitment to a quiet, boring narrative that reliably produces superior long-term results because it minimizes the impact of human error. Fire-based asset allocation versus hyperspeculation. The rational goal of the FIRE movement, early financial freedom, is often subverted by the high-velocity narrative of instant wealth. Shiller would point out that using option gambling or cheap leverage through technology to achieve FIRE goals is a massive narrative failure. It is a narrative of speed overriding the narrative of security. He would argue that the only way to safeguard a fire-based asset allocation is to prioritize a narrative of capital preservation, ensuring the portfolio survives inevitable shocks, over the narrative of maximum growth, passive investing, and ETF dominance. The dominance of index funds is a reflection of the strong, resilient narrative that trying to beat the market is a sucker's game. This is a healthy, rational narrative. However, Shiller would caution that the very success of this narrative creates a potential risk. The high concentration of capital creates a liquidity cluster. If a sudden crisis were to trigger a shift toward the counter-narrative, the fear that passive is dangerous, the synchronized selling would be catastrophic. The narrative of safety creates a single point of failure. In conclusion, Shiller would see the modern market as a hyper-efficient transmitter of human psychology. Digital markets do not make people more rational. They simply provide the perfect infrastructure for amplifying greed and fear. The individual's greatest offensive strategy against this constant onslaught is narrative literacy, the ability to identify the contagiousness of the stories driving prices, and to maintain an internal, rational, long-term story that no external hype or panic can penetrate. The battle for market returns is fundamentally a battle against the persuasive, emotional, and highly contagious stories of the crowd. We have navigated a compelling, often overwhelming landscape of narrative economics, guided by the profound insight of Robert Shiller. The journey has revealed a fundamental truth. The economy is not governed by equations alone, but by the viral power of the stories we tell. Every crisis, every bubble, and every enduring trend is tethered to a narrative, a simple, emotional, and contagious story that synchronizes the fears and ambitions of millions. The price of an asset, whether it is a stock, a house, or a cryptocurrency, is at any given moment the current, collective belief in its dominant story. The ultimate lesson of narrative economics is one of intellectual humility and rigorous skepticism. It demands that we stop asking, what is the rational value of this asset? And start asking, what is the story that is making people act irrationally about this asset? This shift in perspective is the only reliable shield against the emotional contagion that drives financial ruin. It teaches us that the greatest risks are not found on a balance sheet, but in the pervasive, unchallenged narratives that lull the public into a false sense of certainty. We must become not just financial analysts, but narrative epidemiologists, tracking contagion, anticipating mutation, and preparing for the inevitable moment when the story breaks and is replaced by its catastrophic counter-narrative. Here are the 10 timeless principles from Robert Shiller's narrative economics, and how any normal person today can apply them to achieve long-term financial discipline. Narratives are the true drivers of bubbles and crashes. Recognize that massive market movements are not typically caused by a sudden change in fundamentals, but by the viral spread of an infectious story, e.g., the new era is here, or systemic panic. Application. When a stock or asset's price rise is justified solely by a compelling, widely told story rather than verifiable cash flow, treat the asset as a high-risk bubble waiting for narrative to fail. Monitor narrative contagion, not just price. The riskiest moment is when narrative has achieved peak saturation, when everyone, including non-experts and casual acquaintances, is repeating the same story of guaranteed wealth or impending doom. Application. View media saturation, social media trending, and general public certainty as a contrarian indicator. When the story is loudest and most universally accepted, reduce exposure. The story must be simpler than reality. Infectious narratives succeed because they provide simple, emotionally satisfying explanations for complex economic events. They replace nuanced risk analysis with clear, emotionally charged conviction. Application. Be deeply skeptical of any financial advice or investment thesis that can be summarized in a catchy slogan or a short video. True, long-term value is usually boring and complex. Guard against self-fulfilling prophecy narratives. Be aware that certain stories, especially narratives about inflation, bank solvency, or market crash, gain power because a collective belief in the story causes a predicted outcome to materialize. Application. During periods of high fear, do not allow the panic narrative to dictate your actions. Stick rigidly to your predefined, rational decision structure, DCA/rebalancing, to avoid participating in a collective self-fulfilling panic. Acknowledge the power of the legitimacy narrative. The stability of the entire financial system rests on the narrative that institutions, banks, regulators, central banks are competent and trustworthy. Application. Understand that massive market panic is often a loss of faith in this core narrative. Maintain a substantial liquid cash reserve to act as a personal hedge against the possibility of a narrative-driven systemic crisis. The FIRE goal must override the FOMO narrative. The long-term, low-risk narrative of financial independence is constantly challenged by the high-velocity, high-emotion narrative of FOMO and hyper-speculation. Application. Formalize your asset allocation, DCA, passive investing, as your core narrative and commit to it. Treat any speculative impulse, meme stocks, crypto, as a violation of your long-term story. Ensure it is only ever a tiny, defined, and expendable part of your capital. Identify the narrative of technical obsolescence. Be wary of investment narratives, particularly in the tech sector, that claim all traditional valuation metrics are suddenly obsolete because of a new era or disruption. Application. Insist on a clear path to fundamental profitability. Recognize that the narrative of eyeballs over earnings is recurrent and has historically led to massive, catastrophic bubbles, .com, certain crypto sectors. Resist the narrative of moral outrage, narratives driven by moral indignation, e.g., fighting the rig system, are highly contagious and emotionally potent, often leading to financially irrational coordinated action. Application. Separate your political and moral beliefs from your financial decisions. The market does not care about your moral position. It only rewards objective, probabilistic analysis. Do not gamble money based on a feeling of resentment. The narrative of stability is an asset. Recognize that the low-cost, predictable returns of broad index funds and ETFs are contingent upon the strong, pervasive narrative of market fairness and global economic growth. Application. Continue to support and invest in passive, diversified funds, but always monitor the health of the systemic narrative. The ultimate stability is found in the dull, proven story of long-term compounding. Embrace narrative literacy as your ultimate alpha. The greatest edge in the modern digital market is not superior data, but the ability to read the collective mind, to understand prevailing stories and detach your own decision-making from their influence. Application. Make a conscious effort to consume financial information from diverse, even skeptical, sources. Always ask, if the story is true, why is the opportunity still available to me? To expose the underlying narrative flaw. The wisdom of Robert Shiller is a call to action, to master the art of disciplined skepticism. You cannot stop the stories from spreading, but you can control whether they infect your own decision-making. You must arm yourself with the rational, long-term story of patience, consistency, and probabilistic thinking, making your financial life a fortress against the constant, compelling, and contagious narratives of the crowd. Deliver your closing thoughts with clarity and power. This is the path to moving beyond the whims of narrative and toward the enduring freedom of rational conviction. This is how you take back control of your financial future. The silence you hear now is the sound of the market's narratives finally fading away. We have just completed a rigorous, essential journey through narrative economics, learning that the true drivers of wealth and ruin are not complex mathematics, but the simple, emotional stories that go viral. You now possess the ultimate financial superpower, the ability to recognize a contagious narrative and to protect your capital from its infectious influence. You have learned to see the market not as a battlefield of numbers, but as a theater of collective psychology, and you know the only reliable script is one of long-term discipline. The work, however, has just begun. Applying the lessons of Robert Shiller means committing to a lifetime of narrative surveillance and emotional self-control. It means resisting the next hype cycle, ignoring the next fear-driven headline, and sticking to quiet, boring, and mathematically superior story of your own long-term plan. If this deep, cinematic breakdown of narrative economics has fundamentally changed how you think about markets, money, and your own decision-making, you need to make sure you are subscribed to Capitura. We exist to bring you this caliber of knowledge, the rare, foundational works that separate those who merely participate in the financial world from those who truly understand how it works. Our mission is to arm you with the intellectual frameworks necessary to navigate chaos and uncertainty. Hit the subscribe button now. Turn on notifications so you are ready for our next deep dive. Because next, we're covering another classic that is mandatory reading for every serious investor. It's a book that explores the profound, often invisible, effects of global macro forces on your local portfolio. It's about why the stability you see is often an illusion, and how to be prepared for the risks that everyone else is ignoring. You won't want to miss it. We have already explored how Robert Shiller meticulously mapped the viral spread of stories through economic systems. We understand that the price of a stock, the trajectory of a bubble, and the depth of a panic are not merely reflections of underlying value, but are the visible symptoms of a powerful, invisible hand, the hand of narrative. This hand dictates where capital flows, who is deemed a genius, and which risk is collectively ignored. But the true genius of narrative economics lies not just in identifying that stories matter, but in providing the intellectual toolkit to analyze them with the same rigor that one would apply to a balance sheet or a yield curve. Shiller compels us to move beyond simply acknowledging human irrationality and into more advanced, challenging territory of predictive sociology. We must ask, what are the archetypal narratives that recur across centuries? How precisely do these contagious stories dismantle the most fundamental assumptions of financial theory? And most critically, how can the individual investor construct an internal defense system against narratives that are now amplified by powerful algorithms designed to exploit our deepest fears and greed? This next phase of analysis requires a philosophical deep dive, moving from the specific examples of the book into the universal laws that govern human behavior in finance. We will trace the genealogy of economic stories, systematically proving why the traditional financial models failed, and ultimately building the framework for a narrative-aware investment strategy that can thrive even when the world is swept up in the most viral, contagious mania. The stories may change, but the script remains the same, and mastering that script is the ultimate form of financial literacy. The power of narrative economics is rooted in the realization that economic stories are not created whole cloth. They are recycled archetypes. Shiller's research demonstrates that throughout history, every major bubble, panic, and structural shift has been driven by variations of few core, fundamental narratives that tap into deep, timeless human desires and anxieties. Understanding this genealogy of economic narratives allows a sophisticated investor to spot a new bubble not by its technological clothing, but by the ancient story it wears beneath. One of the most potent and enduring narrative archetypes is a utopian dream, often delivered to the vehicle of a technological revelation. This narrative promises an end to scarcity, the obsolescence of old labor, and the creation of a perfect, frictionless economy powered by a new invention. Historically, this was the story of the canal booms, the railway manias, and the electrification craze. In the modern era, this narrative has been spectacularly manifest in the dot-com boom, the rise of Bitcoin bubbles, and the speculative frenzy around artificial intelligence. The core story is always the same. This time is different. The specific technology, whether the internet in the 1990s or decentralized ledgers in the 2020s, serves as a hook that allows the investor to psychologically detach from historical precedent and traditional valuation metrics. The story grants moral permission to ignore the need for profits, cash flow, or sensible price-to-earnings ratios. Instead, the focus shifts to metrics that reinforce the narrative, such as potential users, disruption capability, or network effect. Shiller notes that this utopian narrative is so infectious because it blends genuine, transformative technological progress with the intoxicating promise of instantaneous, unearned personal wealth, creating an almost religious fervor that blinds participants to the simple mathematics of competition and eventual mean reversion. The danger of this narrative is that it sustains prices at absurd levels long enough to allow massive capital reallocation, ensuring that when the eventual narrative failure occurs, when people realize utopia is decades away, or that competition will devour the profits, the resulting panic is systemically devastating. The individual investor must learn to see the Tesla hype and the crypto hype cycles not as a financial event, but as a performance of this ancient utopian script, demanding rigorous skepticism about its timeline and its inevitability. A second, equally powerful archetype is a conspiratorial fear narrative, which asserts that the system is not merely flawed, but is intentionally rigged by a hidden, malevolent elite. This narrative thrives during periods of high, visible inequality and economic stagnation, providing a simple, satisfying explanation for personal failure and a clear target for collective action. Shiller traces this narrative through various historical forms, from the 19th century suspicion of powerful banking trusts and robber barons to the modern manifestation in the meme stock phenomenon. The retail traders' coordinated action against institutional short sellers was explicitly driven by the narrative of injustice, the story that the system is stacked against the common man, and that collective action is a moral fight to regain fairness. This narrative provides an immense psychological booster shot, turning a simple financial trade into a moral crusade, which dramatically increases participants' risk tolerance and dedication to the trade, overriding traditional bankroll management principles. The danger here is that the narrative can blind participants to the statistical and capital superiority of their opponents. While the underlying story of inequality may be true, the financial market remains an arena of capital allocation, not moral justice. Shiller shows that even the most righteous narrative eventually succumbs to the cold, mathematical reality of limited capital and infinite counterparty patience. The intelligent investor uses this narrative not to fuel a risky trade, but to anticipate political and regulatory risk. Knowing that when conspiratorial fear narrative achieves peak contagion, governments are compelled to step in with policy changes to restore the narrative of fairness. A third potent narrative is a Malthusian doom narrative, which predicts inevitable scarcity and collapse of resources, systems, or economic vitality. This story, rooted in the idea of diminishing returns and finite resources, generates powerful panic and scarcity hype. This narrative was powerfully active during the global inflation waves of the 2020s. The Malthusian story, simplified for mass consumption, became, governments are printing infinite money, but resources are finite, therefore fiat currency is doomed. This narrative drove massive capital flows into perceived scarce assets like gold, land, and Bitcoin, creating a narrative-driven demand bubble for these assets. The fear of being left behind, the ultimate FOMO, is accelerated by the perceived finality of the collapse. Shiller's analysis reveals that this narrative is highly effective because it plays on a deep, primal fear. However, it often fails to account for human adaptability and technological innovation, the very force driving the utopian narrative. The Malthusian story is a narrative counterpart to Black Swan. It is a predictable fear of the worst-case scenario. The investor must recognize that the most profitable move during a Malthusian panic is often to buy assets that are currently being irrationally dumped due to short-term fear, knowing that the economy's long-term positive EV usually overcomes a narrative of immediate collapse. By understanding these archetypes, utopian, conspiratorial, and Malthusian, the investor is armed with sophisticated narrative taxonomy. They can look at the current chatter around AI disruption, deglobalization fears, and crypto volatility and recognize the ancient stories being retold. This taxonomy serves as the first line of defense against the psychological manipulation inherent in modern financial cycles. The most radical implication of narrative economics is its systematic, devastating dismantling of the efficient market hypothesis, EMH, the academic bedrock of traditional finance. The EMH states that asset prices fully reflect all available information, implying that beating the market consistently, finding alpha, is impossible, and that price fluctuations are rational responses to new data. Shiller's work proves this model is fundamentally broken by introducing the concept of a rationally persistent narrative. Under the EMH, the price discovery mechanism should be instant and rational. If a company's fundamental value is $100 and it is trading at $50, rational actors should immediately buy, pushing the price to $100. Shiller demonstrates that this fails because the narrative provides compelling, psychological reason for the price to remain irrational for sustained periods. Consider a company trading at an absurd valuation, such as a meme stock trading at 50 times its revenue with no clear path to profitability. The rational economist sees a clear mispricing, but the narrative economist sees a powerful, contagious story of the short squeeze, the underdog fight, and infinite potential. This narrative acts as a psychological tax on rational traders who wish to short the stock, as they know the collective emotional power of the retail narrative is currently stronger than the fundamentals. The narrative creates a rational persistence, the ability of an asset to trade at non-fundamental prices for months or years, simply because the story supporting the price is highly infectious and widely accepted. This persistence completely voids the premise of EMH. The market is not pricing in all available information, i.e., the balance sheet. It is pricing the contagious, emotional belief in the dominant story, i.e., the narrative. The price reflects the collective psychological momentum, not the fundamental economic reality. The duration and magnitude of bubbles are not statistical anomalies. They are measures of the viral load and resilience of the utopian narrative attached to the asset. Shiller's work reveals that narratives create their own unique form of information asymmetry, which is often exploited by sophisticated players. The traditional EMH assumes that all relevant financial data is equally available. But Shiller argues that the most valuable information in a narrative-driven market is sentiment and psychological contagion. A professional trader using Shiller's framework understands that the emotional intensity of a narrative is a far better short-term indicator than the P/E ratio. They actively track narrative indicators, search trends, social media sentiment, the frequency of emotional language, to measure the narrative's current viral load. When a narrative about an asset like Bitcoin is transitioning from skeptical curiosity to universal inevitable certainty, the narrative trader gains an asymmetry. They know the asset is approaching its peak saturation, signaling a major reversal, even if the fundamentals are unchanged. The emotional data becomes the only data that truly matters in predicting the short-term top of a bubble. Furthermore, narratives create asymmetry by omission. A powerful narrative often causes millions of people to simply ignore contradictory information. The narrative of house prices never fall caused lenders and borrowers to actively omit the information regarding rising delinquency rates. The narrative of technological revelation causes investors to omit information regarding competitive threats or capital burn rates. The narrative acts as a cognitive filter, and the professional investor's edge lies in simple yet difficult discipline of actively seeking the information the dominant narrative forces the crowd to ignore. The failure of EMH is the failure of the market to overcome its own narrative-induced blindness. The EMH posits that irrational price deviations should be instantly corrected by rational, profit-seeking arbitrageurs. Shiller demonstrates that narratives effectively cripple the self-correcting mechanism. The arbitrageur, the rational actor attempting to short the overvalued asset, is exposed to the narrative persistence risk. When the Tesla hype drives a stock to an irrational high, a rational short seller is betting that the fundamentals will eventually win. However, the short seller must maintain their capital while the narrative-driven buying frenzy continues. They are constantly exposed to the possibility that the narrative will get more contagious and more irrational before it collapses. This risk of the irrational market remaining irrational longer than the arbitrageur can remain solvent is the core reason the EMH fails in a narrative-driven world. The professional must respect the narrative's ability to maintain an absurd price and only enter the trade when the narrative itself begins to show statistical signs of decay, not merely when the fundamentals suggest a correction. In conclusion, Shiller's narrative economics provides a new, robust framework for understanding market movements. It refutes the EMH by showing that asset prices are often locked into self-reinforcing, narrative-driven trajectories that defy rational correction until the contagious story itself runs out of new hosts. The market is inefficient because human minds are designed to prioritize simple, emotional stories over complex, rational data. If narratives are the primary drivers of economic outcomes, then the most critical role of governments and central banks is not just managing money supply, but managing the national economic narrative. This phase of the analysis explores Shiller's deep insights into the politics and policy of narrative intervention, how institutions consciously attempt to shape the public's psychological expectations, and the massive risks involved when these official narratives fail. Shiller's work is essential for understanding the modern function of institutions like the Federal Reserve. A central bank's power is no longer purely monetary. It is largely psychological. Its policies are effective only if the public believes a narrative of central bank competence and control. The key narrative intervention is the management of inflation expectations. If the public believes a narrative that inflation is only temporary and that the central bank will keep it under control, they will not demand large wage increases or rapidly raise prices, which prevents the self-fulfilling prophecy of inflation from taking hold. The Fed's communication, the careful, often coded language used in statements, is a constant, highly sensitive attempt to maintain the narrative of stability and control. When the Fed's narrative fails, as happened during the global inflation waves of the 2020s, where the public rapidly adopted the counter-narrative of the Fed has lost control, The policy tools, like interest rate hikes, must become exponentially more aggressive to break the now viral inflationary expectation narrative. Similarly, in a banking crisis, the central bank's primary action is not necessarily injecting capital, but immediately and decisively issuing a narrative of absolute guarantee, the story that deposits are safe and the system is sound. This narrative intervention is designed to stop the viral narrative of mistrust, the bank run, before it can fully contaminate the public mind. Shiller demonstrates that the success of this intervention is entirely dependent on the credibility of the institution's narrative history. Fiscal policy, government spending and taxation, is also deeply intertwined with narrative management. When a government implements a massive stimulus package, the success of that policy is dependent on the narrative of economic recovery. A government must craft a compelling story that convinces consumers and businesses that the stimulus will work, leading them to start spending and investing. If the public instead adopt a narrative of government waste and unsustainable debt, they may hoard the stimulus funds, anticipating future tax hikes or economic collapse, thus crippling the policy's effectiveness. Shiller shows that the New Deal in the 1930s was as much about creating a narrative of renewed hope and collective action as it was about spending money. The spending was the physical manifestation of the story. The modern challenge, particularly in democratic societies, is the constant political competition between narratives. Every policy is immediately translated into a political story: tax cuts for the rich versus investing in the future. And the economic outcome can be dictated more by which political narrative achieves greater viral dominance than by the fundamental mechanics of the policy itself. Shiller's work provides a critical tool for citizens, evaluating policy not just by proposed mechanism, but by its probable narrative effect on mass psychology. Finally, Shiller analyzes how financial regulations are both a product of and a manager of narratives. Regulations are often created in the emotional aftermath of crisis, driven by a powerful narrative of scapegoating and moral justice, e.g., we must punish the bankers. While necessary, these narrative-driven regulations often focus on preventing the last crisis, failing to anticipate the next one. Crucially, regulations also create moral hazard narratives. The story of the government will always bail out big banks, the too-big-to-fail narrative, subtly encourages reckless risk-taking by large institutions, as they know the ultimate narrative of systemic stability will force a bailout. This narrative essentially voids the rational economic incentive against taking excessive risk, leading to the collective pursuit of cheap leverage through technology and complex, interconnected trading that benefits from the implicit government guarantee. Shiller reminds us that the ultimate test of any regulation is whether it successfully changes the underlying incentives narrative, not just whether it adds another layer of complexity to the rules. In a world where meme stock manipulation and the crypto casinos are challenging the very concept of regulated finance, Shiller's framework is essential. The narrative of market fairness is fragile, and if governments fail to successfully counter the narrative of the rigged system, capital will continue to flow into unregulated, high-risk territories, creating narrative-driven instability that policy is increasingly unable to reach. The politics of economics is fundamentally the politics of storytelling. For the individual investor, the ultimate practical application of narrative economics is the construction of an internal, personalized narrative defense system. Since the modern market is a hyper-efficient machine for exploiting human emotional and cognitive biases through contagious stories, survival and success depend entirely on one's ability to remain psychologically anti-fragile to the market's narrative assaults. This is the advanced application of the FIRE movement's core discipline. The first and most critical element of defense is narrative literacy. This means training oneself to identify and categorize narratives instantly, stripping away their emotional content to reveal the simple story beneath. The defense mechanism is to never ask, is this story true, but rather, is this story contagious? The investor must learn to recognize the emotional cues. Narratives driven by fear, Malthusian doom, or envy, conspiratorial injustice, are the most dangerous because they compel immediate, irrational action. The individual must cultivate a contrarian narrative lens, where the universal acceptance and high emotional intensity of a narrative serve as the loudest possible warning sign to reduce risk or take the opposite position. For example, When the Bitcoin bubble story is so pervasive that it justifies multi-thousand-dollar options bets by new retail traders, the only rational response is to sell into the narrative strength. The price reflects the story, and the story is about to peak. This literacy extends to recognizing the narrative tax. Every time the investor acts on a highly contagious story, buying the hype, selling the panic, they are paying a narrative tax to the disciplined counterparty who sold to them or bought from them. The cumulative cost of paying this tax, through repeated small emotional errors, is the primary source of financial underperformance for the amateur. Since the external market is constantly attempting to impose its volatile, high-risk narrative onto the investor, the only permanent defense is to construct a powerful, resilient internal narrative of process. This is a story the investor tells themselves that overrides the external noise. This internal story is one of long-term patience, mechanical consistency, and probabilistic certainty. It includes the narrative of mechanical consistency, DCA, the story that my wealth is built by the clock, not by the market. Dollar cost averaging, DCA, is not merely a strategy. It is a mechanical discipline designed to enforce the superior narrative of slow accumulation, ignoring the siren song of short-term timing. The narrative of probabilistic humility, the story that I do not know what the market will do next, and that is okay. This narrative counteracts the toxic external story of gurus and certainty. By accepting that all decisions are probabilistic, the investor frees themselves from the emotional agony of being wrong, which prevents the subsequent ruinous emotional spiral known as tilt. The narrative of survival is ultimate success, the story that the only way to lose is to be wiped out. This reinforces the bankroll management rule, ensuring that the fire-based asset allocation prioritizes longevity and capital preservation over maximum growth. Cheap leverage through technology is instantly framed as a violation of this core survival narrative. Finally, the investor must establish narrative boundaries. Specific, mechanical rules designed to physically insulate the decision structure from emotional contagion. The information diet. Curating an information feed that minimizes exposure to emotionally contagious, short-term narratives. This means actively filtering out financial TikTok and YouTube gurus and high-frequency noise, opting instead for long-form, fundamental analysis that is difficult to translate into a viral story. The time lag rule, imposing a mandatory time delay between hearing an emotionally charged narrative, e.g., the stock is collapsing, sell now, and taking action. This break allows a rational process to reassert itself over the emotional impulse, forcing the trade to be checked against the objective, long-term rules. The anti-narrative portfolio slice, maintaining a small, defined portion of portfolio, e.g., 5 to 10%, specifically for speculative, high-narrative plays, like option gambling or volatile crypto. This allows the investor to psychologically pay the narrative tax by satisfying the emotional need for excitement without compromising the core, long-term wealth engine. This disciplined allocation acts as a firebreak, containing the emotional risk so it cannot contaminate the entire bankroll. By adopting this comprehensive narrative defense system, the individual moves from being a victim of the market's psychological forces to a disciplined, narrative-aware participant, using the contagion of others as a primary indicator for their own calm, contrarian action. This is the ultimate execution of Shiller's vision, turning the greatest weakness of human economics, the power of story, into the greatest strength of the disciplined investor.